Hi, I'm Steve Van Metre, and welcome to your weekly economic update where we try to cover everything we can in about 30 minutes. And I've got a lot of stuff that I want to talk about. We got the payroll report, we got the direction of the US dollar, what's driving the market, and if that's going to roll over, answer is yes. And probably some other things I'll forget about, but hopefully if I got my bookmarks right on the screen, we'll cover them all. All right, so let's talk about what's driving the market. It's not a surprise that we were going to have an earnings recession. The money supply has been decelerating, and when there's less money in the economy or less growth, you can't make as much money. So if the money supply is, say, growing at 3% a year, an arbitrary number, you're not going to have corporate earnings at like 20-some%. It doesn't make sense. The only way you can drive earnings higher is if, one, the money supply is increasing, two, your profit margins, increase. Well, earnings, your revenue, in terms of sales, has to be increasing, and then it all leads down to the end of the day, the profit margin. And if the money supply is not growing, well, the rubber at some point meets the road. Now, from an investor standpoint, an earnings recession usually means stock prices come down. This time, stock prices went up. And the reason they're going up is because the general belief from the investment community is that this earnings recession is a nothing. It's going to be mild, maybe 1-2 quarters at the most. And by the second half of the year, nope. I'm terrible at this arrow thing. I'm just, there. They think stocks are headed up. And that's a dangerous view to have, because if all we're having is an earnings recession, then the broad economic data would suggest otherwise. It would say, yeah, you know what, you're right. We are having an earnings recession. Earnings got too hot and they need to cool off. Consumers a little, tapped out. They need to cool off. And then this show needs to resume. But the reality is that that's not what the economic data is saying. The economic data is going down, not just domestically, but globally. And globally, it's way worse than it is domestically. And investors are saying, no big deal. The Fed's going to bail us out. I don't need to worry. Well, that's a really dangerous view, because the Fed didn't bail you out in the housing bubble. The Fed didn't bail you out in the tech bubble. So how's the Fed going to bail you out now? The content of this video is provided as educational information only, is not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or selling a security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. Opinions expressed in the video that I do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So let's talk payrolls. And while I pull up my spreadsheet, I actually remembered this week to put some of my spreadsheets on the hard drive, because I ran out of USB ports, and I wanted to share them with you, but I keep forgetting to copy them over, and I can't slot my USB drive in when I've got all the plugs. I know I could buy an expander for that, but whatever. Anyway, so the payroll report looked pretty good on the headline number. In fact, it came at 263,000 jobs, which I'm going to just be straight up front with you. I'm surprised, because this hiring decisions go back to January. In January, we were coming off a very weak holiday season in terms of spending. So you wouldn't think there'd be that much demand to hire. Of course, unless corporations think that there's this big boom coming too. And then, of course, that would drive them to hire. But it doesn't look like that's what's happening at all. Now, underneath, there are two data points that the Bureau of Labor Statistics puts out. They put out the headline payroll data, and then there's something called the household survey. They're done differently, and lately they've been, with different results. The headline payroll report says, my God, inflation is going to take off. The economy is just pent up with demand, and it's going to explode, and you better get on this train because it's going, No, there it is, up. But yet the economic data keeps falling as all these people are getting hired. Because there's a couple truths about the payroll report. They don't make a difference. They do not give you any predictive direction on the overall health of the economy. They are a lagging feature of what's really going on here. And the Fed thinks people being at work creates inflation. It doesn't. It doesn't at all. What's the difference between, okay, so how do you get inflation, right? I know this is, if you heard this before, it's because I say it a lot. Inflation is when the money supply expands on its own, due to the Fed, due to something, whatever. And there's only two ways. The Fed, which really can't expand it, but they can lower interest rates and quantitatively ease. But the number one way, the only way the money supply expands is by borrowing. So you get inflation from borrowing. Now, does it matter if I go buy a car or a business goes out and buys a car? Doesn't matter. As long as it's financed, doesn't matter. That's how the economy grows. The more debt our economy has, the more inflation you get, and the more growth you get. Theoretically, the problem with a debt-based economy is you reach a point where debt does not create growth and the system falls on its face. It's just a design failure. I'm not knocking the system. I'm just saying it never was designed to work long term. It was designed originally to enrich a very small number of people on the planet. To put that in perspective, 2 years ago, roughly 62 people in the world control 50% of the wealth. I know you're like, wow, I wish I was one of them. 62 people control 50% of the wealth. Do you know where that number is today? Take a guess. It's like 24. Less than half the number of people that were rich, well, I'm sure they're still rich, or not as rich. Because that's what happens in these type of economies when the Fed does all this monetary easing and all this stuff and central banks ease. They enrich a very small number of people, and then when they tighten, it squeezes everybody from the top down. It absolutely does. But it doesn't create inflation at all. I mean, there's no evidence of any form that it creates inflation. None. Doesn't matter who borrows the money. Doesn't matter if me, you, a corporation, as long as someone's borrowing, that's inflation. And borrowing data is falling. And this payroll report, well, you'd think we'd have a lot of inflation, but we don't. So let's take a look. And now what I do is I download this data from the Federal Reserve website, and this is from the Bureau of Labor Statistics. And here you can see that 263,000 was the jobs created that they posted. Now here is the birth-death model. And I want to show you this. I'm going to have to, okay. Got to make sure we're all looking at the same thing because there's too many times that happens. So all I did was type in my search engine, BLS birth-death model. First hit, birth-death model. So there you can see. There is an unavoidable lag between an establishing opening for business and its appearance to sample on the sample frame, make it available for sampling. So they're essentially saying, we can't count these new businesses every month. They're starting because, well, we don't know they exist yet. Because new firm births generate a portion of employment growth each month, non-sampling message must be used to estimate, keyword estimate. Now, where am I getting this number from? I literally just scroll down. Here's a 2019, and here's the number of jobs according to the birth-death model. Got it? Good. And I put that over here. Now I'm going to switch back, make sure, no, we're not on the, okay, let's try. There we go. Okay, so I punched this in here, 281. This is my BLS birth-death model column, and I subtract them. And it turns out that more fictitious jobs were created this month than real jobs, minus 18,000. Now, according to the BLS, we've averaged about 169,000 jobs per month for the last 3 months. That's generally pretty weak. When you start getting under 150,000, it's not good for the economy. And if it wasn't for this big number here, this 263, wow, then we would be there. Now, if we go over here to the birth-death model, adjusted numbers, you get an average of 13,000 jobs created. Does that start to make sense in why the economy is not looking as good as the stock market suggests that it is? Well, it should, because that's what we're seeing. My my stepson, that's just not whatever's coming here to here, not speaking together very well at the moment. My stepson works at the local Chevrolet dealership. And some of you may know him, some of you may have seen him, and maybe none of you have bought a car from him. But nevertheless, he said March was a really good month. Everyone there was selling cars. No matter if they were good or bad at selling, didn't matter. They were selling a lot of cars. And I said, it won't last because this is the side effect from the tax refund season. Now, normally that kind of runs 2 or 3 months in the car industry because people are getting refunds. However, refunds were down 2% this year. That's not a big number, but they were down a little bit. In April, he said, and I could be misquoting him, but if I believe what I remember him saying is not one person sold more than 3 cars in April. That does not imply that everybody sold 3 cars. It just means that nobody sold more than 3. And from a banner month in March to one day he said he went to work on his entire shift, not one potential customer walked through the door. That's a big change in the economy. And the reason we're discussing this is because it's important. Too many investors focus on price. Oh, housing is going up in price. It must be a great investment. I'll throw all my money. If stock prices must be going up, the market must be right. The stock market is always wrong at the end. It's always wrong. You don't believe me? Simple. Did you get out of the market right before the tech bubble blew? Probably not. Did you get out of the market before the mortgage bubble blew? Probably not. Why? Because the market didn't tell you. The analysts don't tell you. The people on TV don't tell you. People on the radio, newspaper, magazines, they don't tell you the truth because they get fixated on price. Well, Steve, the price is rising. You got to be in it to win it. Yeah, I know. Until the thing blows apart and goes down, and then you're going to be like, man, I'd like to get out, and then you can't. Why don't people get out when the market starts going down? Because one, they don't believe it, and then number 2, when it comes time to sell, click, 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 no buyers. So what do? You sit. All right, let's get back to the normal. So there you go. The payroll report wasn't that great. According to the household survey, we've actually lost 300,000 jobs in the last 3 months. So when they call households and ask them how employment's doing, not so good. When they use their normal things are stellar. And this is where you get into this bizarre circle of things that don't make sense. BLS wants the president to be happy. Now, I'm not specifically saying President Trump. So for those who don't like Trump, whatever, I have no opinion, okay? I'm just telling you, they're not doing this just for him. This went back to President Reagan, who started this, where he encouraged the BLS to fudge the numbers to make people think that the economy was better than it really was. It's true. Go back and look. And the BLS seems to help out whoever is in office. Doesn't matter to them. They're, you could say they're apolitical, maybe they're not, but it doesn't matter. That's what they do. Now, of course, the president, whomever that be at the time, Trump right now, obviously, wants good numbers because what do they want to do? They either want to get A, reelected, B, get their buddies elected, or maybe he's not interested in being reelected, but he wants to walk away being one of the greatest presidents our country has. So, of course, they want good numbers. Now, on the flip side of the chart, they want the Fed to ease. Of course, President Trump has been very vocal about that. But you know what's not going to happen? You're not going to see an easing Fed with 263,000 jobs created. Not going to happen. And why is that? Because the Fed is beholden to the made-up numbers of the BLS. They don't look at the birth death model because they don't care. They don't look at the household survey. They don't care. They look right at that headline number and say, no rate cuts. In fact, they might say rate hike. So you get this bizarre circle where everyone's trying to pad things to make things look good, when in fact, if they just spoke the truth, they could adjust monetary policy to begin with. But they don't want the stock market to go down, because every time the market goes up 10%, it increases the GDP numbers by 1%. That's the math. That's the real number. So the market goes down 10%, GDP goes down. Well, if GDP growth is already pretty anemic to begin with historically, the last thing you needed to do is be weaker. But you get the idea that one hand is lying to the other hand, who's lying to another one, lie. And then the market reacts to the lies. And then when the economy actually drops dead on its face, everyone's left wondering why they didn't see it. Because they don't look at anything but price. All right, now on to the PowerPoints we go. Let me close out some of these windows so I don't get confused with them in the future. All right, PowerPoint. There we go. Money supply. My favorite thing. Money supply versus recession. The growth rate has been revised lower. I was surprised by this. It's now down to 3.61%. I was only surprised by how much it seems to have dropped. and it dropped a lot down to 3.61% annualized. And I said this was headed lower, but I was not expecting such a big 1 week drop. The 6-month rate of change is sitting at 1.58% and is held flat. The 3-month rate of change is at 0.05%. That is not a typo. Effectively, over the last 3 months, the money supply has not budged. And the growth rate last week dropped $40 billion. That's staggering. And now we are back in the red zone where recessions occur when the growth rate of the money supply falls below 3.7%. So there you go. You know that that's what's coming. Now I want to show you the... All right, I got to flip. If you're wondering why I keep flipping back and forth, it's because I see the screen here. It tells me... This over here tells me what you see. So I have to make sure you're seeing what I'm seeing, because that's how goofed up I get with this program. So here is the weekly data on the money supply from the Federal Reserve, and I download a report, and then I do the year-over-year rate to confirm that their numbers match mine, and then I do a 6-month and 3-month column, and I don't have a header up here so you can't really see it, but that's what these are. So here is the 3-month rate of change, and how do we know it? Because I can go from here to here, and we can look at the average, which is 14469, and you can see 144, wow, 69. This thing is not growing in pretty much in 3 months, and that's why we're 0.05%, and we're about to go negative, and this is frightening for a lot of reasons. Not just because we're here in the red zone again, is when you run a chart on it, and I did, you can see that recessions are prevalent. 1987, recession. 1989, before the bull market, we had a little soft recession. 1984, I graduated high school, recession year. Look at the growth rate of the money supply, it's weak. 2002, nearly double dip recession. 2004, I don't recall off the top of my head. 2008, look, we had a recession when the money supply was going way up here, and it just crashed due to all these mortgages blowing apart. But look, 2010, we almost had a double dip recession. And now look, where the growth rate of money's 3-month money supply is headed negative. It is headed negative, and there's no stopping this thing at the moment. Now there's something that's going to stop that could do it, and I suspect it's going to happen. But I just want to point out the money supply is telling us something dangerous is going to happen. If you go back, like I said, to the dot-com bubble, look at how strong the money supply is growing. You didn't see a recession coming here. I mean, here's a recession from roughly 1999. This was the recession right here. And people are like, why did you get wigged out over this? Because look right here. This caused an 80% drop in the NASDAQ. Here is what happened. Oh, wait, that's not 2008. Here's 2007. The recession kind of got started late 2007, so that would be right about here. And look, it hardly went down. So when I see this long deceleration into recession, yeah, that's what makes me think that something's wrong. And sure enough, something will be wrong. So, all right, let's get back to the PowerPoint. And we are in the red zone. There's no more fiscal stimulus, no more monetary stimulus. Nothing's going to change that. It should continue to roll over. And look at the commercial and industrial lending. I said at some point this is going to roll over. And this is important for the money supply too. The growth rate is still at 7.1%, or down to 7.1 from about 7.5% from last week. Still at 4.9% a year ago. So overly not terribly strong growth, but it's rolling over and headed down. And remember, money supply is created by lending, and we're not, in the last 3 months, we haven't done anything, and now this is rolling over and heading down. Let's look at consumers. They're not borrowing as much either. They're still borrowing at a 4.31% annualized rate, which is pretty solid in general, but it's in a downward trend. So the system is not creating enough money. And the Federal Reserve is continuing to unwind. They dumped $39 billion last week. It's a staggering number. And now, starting this month, the balance sheet unwind will slow to $35 billion from $50 billion per month, if I've got my math right on that. And I double-checked it, so hopefully I've got it correct. Look at the bank deposit growth is down to 1.2%. This is historically super low going into recession because it tells us consumers have no money to withstand a loss of a job. Not at all. No money. Now, looking at stock market, this chart we've seen before, but now only about 25% of the companies are still under their blackout period, And I want you to keep this in mind when we do go look at the trading volume. You'd think trading volume would increase. It really hasn't, which is staggering. So this will slowly fade away. Maybe we'll look at this chart one more time, but we'll see. Now let's talk about Apple. And Apple is one of those companies that has guided and said, hey, earnings is going to slow. It did slow, and their stock rallied because they're buying their stock back, and people think that that's a wonderful thing. And so you can see Apple shares outstanding. I don't know who, Charlie Belio from Twitter. Thank you for posting this. So you can see shares outstanding went from somewhere over 6 billion to 4.71. It's a lot of shares. And share buybacks have gone from virtually nothing to over 70 billion. There it is. It was somewhere, almost 70.1 billion. And Apple is now pledged to buy 75 billion more dollars worth of their shares back. And as their share price goes higher, of course, that means they can't buy quite as many shares. But here's one thing that I want you to think about. Is companies that buy their stock back underperform a lot in the future. And part of the reason is rather than investing in R&D, expanding factories, expanding their technology, the equipment, their IP, or inventing new things, whatever they need to do, they just buy their stock back instead. And in terms of Apple, I know there's a lot of people that love Apple. I don't own any Apple products. I have really no stake in the game. Tried it, didn't work for me, but that's cool. Their next phone, because they are a telecommunications company, allegedly, and they make money selling phones and telephony devices, iPads, computers, whatnot, so people can log on to the internet, go to the Apple Play Store, and buy stuff so Apple makes money. Their next new phone, which will be a 5G-enabled phone, when do you think it's going to be out? Later this year, a couple months, December. How about fall of 2020? So Apple's going to have no major new product announcement for a year and a half. And the question is, in a year and a half, is the product going to be good enough to cause big demand? Yeah, I don't know. Don't know. But in the meantime, they're buying their stock back. And they're buying a lot of it. They bought back 1.9 billion shares in the past 6 years, bringing their shares outstanding down to the lowest level since the year 2000. Staggering. Bank of America Merrill Lynch is suggesting the weakness in the factory sector will lead to a drop in earnings per share. So here's their model taking the factory data of orders and inventories, which is headed down, and the S&P 500 12-month forward earnings per share on a year-over-year basis. So they're saying S&P 500 earnings are headed lower, and yet investors think stock earnings are headed higher. And the global money supply, this is posted on Zero Hedge, is headed lower, and so the money supply is lower. We now know the U.S. money supply is going to start to contract, which is, I'm just shocked, and people think maybe I am crazy. So the global money supply is falling. It's going to start falling faster if somebody doesn't rescue the money supply, and that does not bode well for asset prices. So you can see the global central banks pumped the money supply, and it didn't work. And there's the end of the PowerPoints. Okay, so let's see what else I've got on the... Let's go see what the banks are up to. Want to know why you should buy bonds? Well, it would help if I clicked on the right thing. Remember, what is smart money doing? The banks are the smart money. They added $20 billion, They added 21 billion, looks like $16 billion in Treasuries last week. Quite a bit. 13 billion in mortgage-backed securities, and then 2 billion in non-mortgage-backed securities. Look at this difference. They had roughly $5 trillion in mortgage-backed securities a year ago, not mortgage-backed, Treasury bonds, and they've added over a quarter, $250 billion worth of bonds. You want to know who's smart? It's called the banks. They know what's going on. All right, let's go and look at, this is a great post on Zero Hedge from Sven Henrik of NorthmanTrader.com. Posts on Twitter at NorthmanTrader. Pretty interesting stuff he posts. So if you're on Twitter or you want to go to his website at NorthmanTrader.com. So here you can see this wedge, and here we are in another wedge. And when wedges break, stock prices crumble back down. Wedge is going up, wedge is breaking here. So he's taking, hey, look at the NASDAQ. He's saying, look at the Dow. Wedge up, wedge up, wedge up, break. And here's the Wilshire 5000. wedge up, break, wedge up, break. Here's the S&P 500, wedge up, break, wedge up, break. And let's see if he's gotten up that. So what he's saying here is this move up in the market is not bullish. It's a momentum play. And momentum's been driving the market up. And as momentum runs out of steam and buyers run out of money, which they have to because the money supply is not growing. I mean, isn't that crazy? And so this has to roll over and go down. So think about that. Is for all the people who say stock market's going higher, how does the market go higher? Well, somebody pays more for a share of stock than the next person. That's it. But what if you're already fully invested in stocks? Well, you need someone else to buy. And if the market is already fully invested, that makes it interesting. All right, let's take a look at the dollar and where it's headed. So here we are on the Federal Reserve website. This is all, I think we've seen some of my charts, but I just wanted you to see that you can create charts and save them. And somewhere on here, that's what I want. There's some more I want, and I don't, where did I put them? US dollar versus, first, let's take a look at the US dollar versus the inflation adjusted 10-year Treasury yield. And there you go. So what you see is 10-year treasuries adjusted for inflation are headed lower. Value of the dollar should be headed lower. The trade weighted dollars in green. And so when you see yields rising, the dollar rises. Right now, everyone thinks the dollar is headed a lot higher. But this would tell you that if the dollar is headed higher, it's at its final stages of a blow-off move, and it is indeed headed lower based on the direction of 10-year treasury yields. All right, so you say, well, I don't completely buy into that. Okay, how about hourly earnings? Because, hey, doesn't that make a difference when workers make more money, inflation takes off? Let's take a look. Well, inflation-adjusted earnings are headed lower. And yes, you are correct. When inflation-adjusted earnings are rising, the dollar rises. When inflation-adjusted earnings are falling, the dollar gets over this peak and should start rolling down. So here we can see a good example. The inflation-adjusted earnings are headed down. The dollar had one final peak and collapsed. Now, why does that matter? Well, if you want to own gold and agricultural commodities, it makes a big difference. Here's the US dollar versus the M2 money supply. And you see money supply in red. So money supply is decelerating. And look how this is a pretty good correlation. Let's zoom it back. And you can see when the money supply is rising, generally the dollar will eventually rise. You see it kind of went down and shot straight up here. Money supply trended down, the dollar trended down, money supply rising, dollar kind of comes back. And here you can see money supply went down, and this little bounce here just triggered this massive bullish move in the dollar, and the money supply didn't react. The money supply is rolling over and headed down. And what does that tell you? That the dollar should go down. Does it mean it's going to go all the way down? No, but you can see that this general relationship is pretty good, but it's out of whack right now, and that means the dollar's got to come down. And there is some logic to this, and it's really simple. Pick a currency that doesn't exist anymore. What's the demand for it? Yeah. So if the economy is not creating a lot of new dollars, demand for them falls. Makes perfect sense. All right, on to the charts, which I didn't leave a lot of time for. But look at the S&P 500 volume, pretty low. For 25% of the companies left in their blackout period, you'd expect that investor sentiment, which is very high, very bullish, should be higher. And what you can see is today's closing high was pretty much where the market was back in September of last year. And yet we've had all this excitement going on, boom, 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 but stock prices are only back where they were and not much higher than they were back in January of 2018. And volumes are falling, which says that everyone that wanted in is back in, and this is starting to consolidate here, like this top, and roll over. This trend is breaking, as Sven Henrik pointed out. I'm not drawing in my own lines here, but it's this rising wedge is breaking, rolling over, and that says the next move is down. Now, volatility also shows that, as we can see, volatility is slowly starting to rise higher, and when volatility starts to eventually rise higher, eventually it breaks out, and here it didn't quite break out, but it got stuck up in this higher range and then took off. And all this is saying is the market is grossly mispositioned right now. The smart money is buying bonds, And they're buying volatility and they're probably shorting the market, or they've just exited their positions. Retail investors are buying stocks, shorting volatility and shorting the bond market. You do the math, who's right more than often than not, and that is the smart money. They know this earnings recession is not temporary. The reason why I show you the money supply data is how are we going to get retail sales to grow? How are we going to get earnings to grow if the money supply is not growing? It's not growing. And think about this. In the last two recessions, the money supply was growing at 8 and 9%. It didn't take much for that to blow up. And now we're about to see the amount of money in the economy shrink. The last time that happened in any real form was the Great Depression. And it happened during the Depression, not at the onset of the Depression. So here we are with everyone bulled up and crammed into stocks, and the money supply is about to turn negative, and there's no sign of anything that is going to create a spur of lending growth. The only thing that can change is if you flush people out of their equity positions, get them to sell their stocks, to go to cash. Could that be happening? Could the smart money be setting us up to do that? I think so. Look at the bond market. We've seen the banks are buying since March of 18. Going back here, they bought $250 million worth of bonds as the public has been selling them. So here's a trend. Look at 10-year Treasury yields confirmed again against their 50-day moving average. We got 1, 2, 3 confirmations that we're in a bearish trend for Treasuries. This are going to go down in the next couple of weeks and retest their December lows. And the stock market has got a huge problem because, as you have seen, and we will look at it again, the S&P 500, which tracks yields normally, is way off base. Completely way off base. Let's take a look at gold. Gold is, it bounced, came back up here, hit resistance off of its neckline of the head, left shoulder head, right shoulder pattern. Pretty typical. Got rejected, bounced up today. This thing is really headed lower. There's nothing. This is not a bullish pattern of any kind at all. Looking at 7 to 10-year Treasury bonds, again, confirmation off the 50-day. This is a now running shot at the recent highs and then higher from there. Same with 20-year, the long bonds, same picture there. Let's take a look at the gold mining stocks. This is a very classical pattern. We're in this rising channel, broke the channel, sell, 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 and it's making these wave moves. So here's your wave 1, here's your wave 2, and we're in wave 3, which probably will take us down here. It'll bounce up, and it usually makes 3 to 5 waves down. It's almost setting us up where this thing is going to go even low. I thought it might stop around this 19. It may go below 19, may get down to the 18s, but it is now showing a very classic pattern of headed lower. It got rejected today at its 200-day moving average, and it's sitting right below this resistance level. If you go back a little farther, this resistance level here, look at where this last support was here and here, and when it breaks this level of support, it went down into here. So it's telling us potentially this is the next major area of support is in this $18 to $19 price range, somewhere in there. That's pretty interesting. The one thing that still surprises me is how short, well, let's come back to that thought in a second. Let's look at the dollar. It got rejected up here. It's probably one last move in the dollar, and it's probably going to roll over based on all the other data. Market is very bullish dollar. What surprises me is the ags that continue to get dumped on as farmers. I just read dairy farmers are now at their highest level of bankruptcy filings in a very long time. I know other data shows farmers are filing bankruptcy as well. We know there's more crop damage, more flooding, and more inclement weather coming. And so a lot of this just surprises me how short this is. But with the dollar rolling over, this could start to put a lot of wind under this, because I know the smart money's buying it because they're very quiet about this. They know what ag commodities do when supply gets ripped from the market, and it can go. All right, so we're about 4 minutes over, so we'll wrap this up real quick. I'll see you on Monday, where we'll see where the hedge funds are. Got a little preview. They're even deeper into their short volatility positions. Crazy. When the smart money rips this market apart, people are going to be surprised. I'll see you on Monday. Bye now.